Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the third video of buyback of shares chapter. Now in the previous two videos we have seen the concept of buyback, and we have also discussed lots of provisions of section 68 of the Companies Act which deals with the buyback of shares. Now those provisions are very essential for you to understand properly, because you will have a conceptual clarity of this chapter if you understand those provisions. So please make sure you have watched the first video as well as the second video, because in the second video we have seen the journal entries. Yes, so I will put the links of both the videos in the description below, so you can go and watch them first and then come back to this video. Now if you have already watched those videos, then never mind, let's start this video. So now in this third video, what are we going to do is, in this video we are going to solve the simple problem of buyback of shares just to start off with. Alright, so let's go to the question over here. Zaveri Limited resolved to buy back 3 lakh of its fully paid equity shares of rupees 10 each at rupees 12 per share. Now from this sentence we can understand that this company is going for buyback of its equity shares, and these shares are fully paid up. They are fully paid up, so you don't have to worry about partly paid up shares and passing additional journal entries to make them fully paid up, because here the shares are already fully paid up. Clear? And then they have given us here the face value of these shares, rupees 10 each, and then the buyback price is also given, that is rupees 12. I've told you in the previous video, right, that the company will offer a premium price, a price that is higher than the face value, okay, a lot higher than the face value. That price they will offer to the shareholders, so that the shareholders will agree to sell their shares to the company. Yeah, not sell in the market, sell to the company. Clear? So that's what is buyback, right? Selling the share, the shareholders selling their shares to the company is purchasing them. Yes, so now that's what is happening here, the buyback price and the face value. Clear? And then they are saying, for the purpose it issued 10,013% preference shares of rupees 100 each at par, the total sum being payable with applications. Now here what they are talking about, here they are talking about complying with the section 68, replacement of capital, and also about the funding. We'll come to that later. Okay, so here just understand that preference share capital is issued to replace the old capital that is going to be cancelled out. Yeah, we'll come to that later, don't worry. And then here again the same thing. See here, the company uses rupees 8,50,000 of its balance in securities premium account apart from its adequate balance in general reserve account to fulfill the legal requirements regarding buyback. Now here they are saying that the company, the company has 8,50,000 balance in the securities premium account, and also enough balance, adequate balance in general reserve also, so that we can fulfill the legal requirements regarding buyback. Now what are the legal requirements regarding buyback? The replacement of capital, that's the thing, and also the funding. Right, how can we do buyback of shares? Only through two ways. Yeah, either through the profits, that is called free reserves, yeah, and also securities premium account also. Now securities premium is not a free reserve, but also we can use that here only in this chapter, only for buyback of shares. Okay, only in this section 68 that Companies Act allows us to use securities premium. Okay, it's not a free reserve, it's a special reserve, but still we can use that. Yeah, so profits can be used to do buyback. And one more way is fresh issue of preference shares. What we do is we issue new capital and get the money to pay off the shareholders for the buyback. Yeah, we'll come to that later, don't worry. So this is what being said over here. So pass necessarily journal entries. Let's solve this problem. Now let's solve this problem. First we have to do this equation and a bit calculation. See, it's very simple. So now here in this question, what is happening? The company is going to buy back 3 lakh of its equity share at rupees 12. Yes, this is the buyback price. So now you have to break this price. What is the face value in it? The face value is rupees 10, and the remaining whatever that is there above the face value, that is premium, the extra. Yes, this is the extra that the company is paying, and this is the capital itself. Yeah, the face value. Yes, so now how can we do buyback of share? Now these are the two things. Yeah, the capital and the premium will be payable to the equity shareholder, the shareholders, equity shareholders. Yes, 36 lakh. Now how did I get this 30 lakh? Simple, 3 lakh equity shares into rupees 10, that is equal to 30 lakh, and then the over the face value amount, that is rupees 2. Yeah, it's 12, right? So rupees 2 into 3 lakh shares, that is equal to rupees 6 lakh. So 6 lakh extra is being paid to the equity shareholders, right? It has to be done so that the shareholders would sell their shares to the company. Yes, so now we have to comply with the section 68, right? So now how can you do the buyback of shares? It's very simple. See here, the section 68 says the company can do buyback of shares only out of two ways. Okay, only by these two ways. The first way is fresh issue of preference shares, yeah, fresh issue of preference shares, or through free reserves. And in this section, free reserve means, you know, securities premium also, both the things. Okay, the divisible profits such as general reserve, profit and loss, dividend equalization fund, all those things, okay, divisible profits, as well as securities premium, only in this section. Okay, actually securities premium is not a free reserve, but only here in this section 68, you know, free reserve includes securities premium. Okay, so these are the two ways the buyback can happen. All right, and then this premium, this is a loss to the company. Why is it a loss to the company? Because this is the extra that the company is paying. Yeah, so this is a loss to the company, and this loss, you know, it has to be written off, and it will be written off out of free reserves. All right, clear? And the first priority here goes to securities premium, SP, securities premium. Yeah, we have 8,50,000 balance in securities premium, so we'll use that. All right, so first what you have to do is, first you have to do this equation. Yeah, break up the price, buyback price, face value, and the extra amount. Yeah, and then what you have to do, you have to first write off the premium. All right, so how will you write off the premium? Simple, 6 lakh you have to write off. And do you have enough money for that? Yes, you have 8,15,000 securities premium, and there is also enough balance in general reserve. But do we need entire 8,50,000 for that? No, only 6 lakh. So we'll use securities premium by 6 lakh. Yeah, easy. Yeah, you have written off this loss. All right, yes, and the funding also will come out of this account only. All right, you will write off this, as well as the funding will come out of this securities premium account. And then what you have to do, you have to comply with the section 68. Yeah, section 68 says whatever capital that was there in your company before the buyback and after the buyback should be same. It should not change. The total paid up capital should remain the same. Now here what is happening, buyback of share is happening. In buyback of share, what the company does, company buys the shares back and cancel them off. Yes, so the capital will decrease. So that should not happen. So for that, you know, there is a way. What is that way? That way is, you know, replacing the capital. How? See here, either through the fresh issue or creating a special reserve called as CRR out of free reserve. That is what is meant by, you know, you can only do buyback either through the fresh issue or through the free reserves, right? You have to create CRR equal to the face value. Okay, fresh issue as well as CRR equal to the face value of the capital that is being bought back. Yes, so now here they have said 10,000 preference share, 10,000 preference shares are being issued at the face value 100. Yeah, 10,000 shares at rupees 100. So that means how much money is coming into the company and how much capital is being replaced? Simple, 10,000 into 100, that is equal to 10 lakh. Yeah, so 10 lakh money is coming into the company to pay off the buyback, and also the capital is being replaced. There are two aspects to this. Always think like this, okay? Replacement of capital as well as the money. All right, so now 10 lakh capital has been replaced. Yeah, 30 lakh capital needs to be replaced. Yes, but 10 lakh is replaced through the fresh issue, and remaining 20 lakh has to be replaced by CRR. Simple as that. So you need 20 lakh in CRR. How much? 20 lakh in CRR. Now how will this come? Now this has to come out of, you know, free reserves. Yeah, free reserves. Yes, so now what free reserves can you use? You can use the general reserve, but you also have money here also left, right, in securities premium. So first let's use that. Okay, securities premium. So now here we have used securities premium by 6 lakh. Yes, we still have how much? 2,50,000, isn't it? 8,50,000. See here, let me show you. 8,50,000 minus 6 lakh. Yeah, still 2,50,000 is there. Yes, so 2,50,000 we can use from securities premium. Yeah, we'll use 2,50,000 from securities premium, and then remaining will come out of general reserve, because general reserve is a free reserve. Yeah, so we can take money out of general reserve, and they are saying we have enough money in general reserve for that. Yeah, it is mentioned here, apart from its adequate balance in general reserve. Adequate means enough. Yeah, we have enough money in general reserve. So how much do we need? If we have got 2,50,000 from securities premium, yeah, and we need 20 lakh. So see here, 20 lakh minus 2,50,000, that is equal to how much? 17,50,000. So 17,50,000 will come out of general reserve. Simple as that. Yeah, clear? Easy, right? So this is what is happening right now. The loss has been written off by securities premium, and then this capital is being replaced by the fresh issue of preference shares and free reserves. Free reserves, I mean transferring the free reserve to CRR. Now here what is happening, this free reserve, right, this free reserve is decreasing. Yeah, what free reserve? Securities premium is decreasing, general reserve is decreasing. Yeah, and this CRR is increasing. This CRR is increasing. So you have to think like this and do the journal entries now. It's very simple to do the journal entries. Yeah, what you have to do first you have to make the due. Yeah, equation itself is the entry, and then you will write off the loss, and then you will comply with the section 68. What is that section 68? Replacement of capital. Yeah, and then creating CRR. Yes, and then at last, after complying with the section 68, you are going to pay off the equity shareholders out of the bank. Yes, so now here what are these? Replacement of capital as well as funding. Okay, here also money is coming in, and here also we are using the money from the profits that we have earned in the past. Clear? So this is the equation and the most important calculation that you have to understand properly. Okay, so that you will not make any mistake in the journal entries, right? Yes, so now let's see the journal entries. Now here we have the journal entries. See how easy and simple it is to pass these journal entries. First you have to look into the calculation, this equation, and this equation itself is the first entry. Yeah, we have the first entry over here. See here, what is happening? We are doing buyback of shares. So we have to pay the capital back to the equity shareholders as well as something extra that is called premium. Yes, so now this capital is being cancelled off. Yes, that is what is buyback, cancellation of shares. Yeah, so to cancel the capital, what you have to do, you have to debit that equity share capital account, debit, because capital always have credit balances. So to cancel the capital, you have to debit that, opposite. Yes, and then this premium, I told you this premium is a loss. So what do we do with losses? We debit all the losses. So premium on buyback account, debit 6 lakh. Clear? Then to whom are you going to pay this money? 36 lakh to equity shareholders, isn't it? So that is what you have to take over here, to equity shareholder account, or you can also take to equity share buyback account. Okay, both the things you can do, fine. But in the CA intermaterial they have taken equity share buyback account, so that's why I have written this over here. All right, so to equity share buyback account. Now here what is happening? Capital is being cancelled off, loss is being recorded. Yeah, this is a loss, and then here liability is being increased because we have to pay. Here we are accepting as a company that money is due to the equity shareholder because of the buyback the company is going for, right? So here the liability is increasing, the liability to equity shareholder, so we are crediting their account to equity shareholder or to equity share buyback account. Clear? 36 lakh. Simple. The first entry would be the equation itself, the due entry. The company is accepting that we have to pay to equity shareholder, ESH. Fine. Then the second entry that you have to do is, to write off this loss. Yeah, premium. How this premium will be provided, how you have to adjust this? You have to adjust this through the free reserves. But the first priority goes to securities premium, and we have used securities premium for that, right? So this securities premium is reducing. All right. So if reserves reduces, if equity reduces, what you have to do? You have to debit that. Securities premium account debit 6 lakh, because reserves always have credit balances. Now you're using the reserve over here to write off the premium. So if you're using the reserve, means the reserve is decreasing. So securities premium account debit 6 lakh, and then here premium, this was debited over here, so you have to write this off, right? So you are going to credit that over here to write that off to premium on buyback. Here it was debited because it was a loss. To write off that loss, you have to credit that. Simple as that. Securities premium account debit to premium on buyback account, 6 lakh being premium on buyback written off. Fine. And then the third entry, you have to go to the fresh issue of preference shares. Yes, to comply with the section 68, what we have done, fresh issue of preference shares, fresh issue of 10,000 preference shares at the face value 100 each. Clear? So that entry you have to pass. So the entry for that is very simple, and in the question itself they have said that entire money is received in application itself. Yes, see here, where is it? Yeah, the total sum being payable with the application itself. Yeah, so the entry would be like this. See here, bank account debit, money is coming in because we have issued the shares, right? And the applications have come in. Yeah, and the whole money has come in with the application. So bank account debit 10 lakh, the entire money, to preference share application account. Yes, now this is a temporary account we open just for application, allotment, like that. We have lots of accounts, right? First call, final call, you know that. So now what do we do with this? We close this account. How do we do that? We have to transfer the money from this account, the balance from this account, to the share capital account, preference share capital account. So the second entry that we are going to pass here, yeah, this entry, preference share application account debit. This account here, it was credited. We are going to debit that account and cancel it off and transfer the balance to the preference share capital account. Yeah, that's what we do, right? We have to increase the capital, so to preference share capital account. Now why is this credited? Because capital is increasing, we are transferring it to the capital account, so capital account, this preference share capital account has to be credited. Simple transfer of application money to preference share capital account on allotment. Yes, the shares are allotted and the money is being transferred to the preference share capital account. Simple. So these two entries are of the fresh issue of preference shares. Clear? And then what you have to do, and then you have to do entry of free reserves. Yeah, here what we have done, we have created the CRR. Yes, 20 lakh CRR we have created, capital redemption reserve, to comply with the section 68. So what we have done here, we have decreased the free reserves and securities premium also, because the section, the Companies Act permits us to use the securities premium, so we have used that. Okay, 2 lakh 50 securities premium and general reserve 17 lakh 50,000. So these two reserves will be decreasing, and these always have credit balance. Yeah, so now they are decreasing. What you have to do, you have to debit them, isn't it? Whenever equity reserve they decrease, you have to debit them. Yeah, so that's what we are going to do. See here, securities premium account debit, general reserve account debit. We have used it by 2 lakh 50 and 17 lakh 50, 2 lakh 50 and 17 lakh 50. Yeah, then to capital redemption reserve. Now this reserve is being created, this new reserve, special reserve, which will only be used to issue bonus shares, right? This capital redemption reserve. Yes, so this reserve is being created now, it is increasing. So whenever reserves or equity increases, you have to credit that, because they always have credit balances. Yes, so 20 lakh. Clear? Easy. Being CRR created to the extent of face value of shares bought back. Now if you can see properly, see here, what have we done? How much capital did we cancel? We cancelled 30 lakh capital. Yes, 30 lakh capital, only the face value. Now only this has to be replaced. Yeah, only this has to be replaced. So to replace that, what have we done? We did fresh issue of 10 lakh and we created CRR of 20 lakh. Yeah, we didn't replace this and all. No, only this, only the capital. Yeah, that's what we are concerned about, only the face value. So that's what it means, being CRR created to the extent of face value, only the nominal value, face value has to be replaced, right? Not the premium and all. Yeah, so what we did was, see here, capital was created of 10 lakh, preference share capital. Yeah, here, and then here we created the CRR of 20 lakh. So in total, this 30 lakh was replaced, isn't it? Here debit 30 lakh happened, then here credit 10 lakh, and then here credit 20 lakh. You see, it is being replaced. Easy. Yeah, so this is what you have to do. This is what is meant by replacement of capital over here. Yeah, to comply with the section 68, that the paid up capital should not decrease, it should remain the same even after the buyback of share. Yes. Yeah, so everything is done, due entry is done. Yeah, and then you have return of the loss, this premium loss, and then fresh issue is done, and then CRR is being created. Everything is done. At last you are going to pay off to the equity shareholders. Simple as that. So to pay them off, what you have to do, see here, the first entry. Here in the first entry, you accepted that you have to pay to equity shareholder, so you credited their account. Liability was increasing in this first entry to equity share buyback account. This account was credited over here. Yeah, we have to pay, money was due, we have to pay. Now the money is paid, the payment has been made. Yeah, so now here what you have to do, you have to cancel that liability. Here it was credited, liability was increasing, now that liability is extinguished, it is scrapped off, because you are paying it off. Equity shares buyback account debit, you have to debit that account. Here it was credited, here you have to debit that. Equity shares buyback account debit 36 lakh. Yeah, that's what you are going to pay them, right? 36 lakh, isn't it? 36 lakh. Yes, so to bank account, your money will be decreasing in your bank account, because you are going to pay through the bank. To bank account 36 lakh. Simple. So these are the simple journal entry that you have to do for buyback of shares. Now in some question, what can happen, you can get investments were sold off to arrange the cash, or some others asset are sold off, or loan is taken, something like that can come, but that is only for arranging cash. All right, always remember, there are only two ways to do buyback of share, either through the fresh issue or through the free reserves. Free reserves, I mean by creating CRR for the remaining, for the remaining balance. Whatever fresh issue has been made, the remaining has to come out of CRR, the replacement I'm talking about. Yeah, but then there is also arranging cash. Sometimes the question will say investments are sold off or debentures are issued. Yeah, something like that can come, so that only the cash can be arranged to do the buyback of share. That's only the cash part. Don't think that's replacement of capital or no. That's only the cash part, selling of investment, issuing debentures and getting a loan and all that. Yeah. And then sometimes the bonus entries can also come, bonus entries, or sometimes redemption of preference shares can also come for C and the guys especially. Yeah, so you also have to be very clear with that chapter also. Yeah, that was in your group 1. Yeah, easy, right? So this is what the journal entries are. Very simple. Yeah, easy, right? Okay, then see you in the next video.